welcome to The Explainer. Today, we are breaking down a seriously unique investment opportunity right in the Near East Side of Indianapolis. If you've been watching the real estate market lately, you already know the struggle. It is incredibly hard to find assets that balance strong, consistent cash flow with reliable long-term appreciation, especially right in an urban core. Well, today, we're diving into the hard data and the exact financials of a brand new construction duplex that just might be the absolute perfect portfolio builder you've been holding out for.
Here is our game plan for today. We'll start with the Near East Side opportunity, look at historic homes versus new builds, meet the property at 330 and Hamilton, dive into the financial snapshot, and finish up with projected investment returns.
Let's kick things off with Section 1, the Near East Side opportunity and its gentrification tailwinds.
It's the ultimate investor dilemma, right? Where on earth can you find cash-flowing properties with low maintenance right in an urban core today? It's a notoriously tough balance to strike. Usually, you end up sacrificing one for the other. You either buy way out in the suburbs for the low maintenance but suffer lower rent growth, or you buy downtown for the massive appreciation but end up bleeding cash trying to maintain a 100-year-old building. This fundamental dilemma brings us perfectly to the Near East Side submarket of Indianapolis.
The locational advantages here are just absolutely prime. We're talking less than 2 miles from Monument Circle, quick access to I-70, and it's right near the highly popular Bottleworks District. Plus, it's anchored by major transit, including the IndyGo Red Line and the upcoming Blue Line. What this essentially means is that demand from neighboring, highly expensive areas is spilling right over eastward into this exact submarket. Now, to be completely objective, you always have to weigh the risk and the reward. The reward here is a high yield potential backed by massive public and private reinvestment, with median home values and rents still sitting below citywide averages. So there is a huge runway for growth. The cons? Well, you're dealing with some lingering perception issues and what we call patchwork neighborhood progress. Basically, not every block is gentrifying at the exact same pace. But honestly, for the savvy investor, that patchwork progress is exactly where the real margin is made.
Moving right along to Section 2, historic homes versus new builds, or as I like to call it, the maintenance divide.
Let's look at the actual data for what's available to buy and rent in this specific area. According to a recent comparative market analysis for residential leases in the 46201 zip code, the neighborhood commands some truly solid rents. The average lease price sits at $1,627, with the high end pushing all the way up to $2,400 a month. But you've got to look closely at the year built. The average home leased in this data set was built in 1931, and some go all the way back to 1885. Sure, those historic homes have a ton of charm, but for an out-of-state or hands-off investor, an 1885 build means hidden maintenance costs galore. You're talking aging plumbing, outdated electrical, and foundation issues that can literally wipe out your entire year's cash flow in a single afternoon.
This really paints the picture of the divide we're talking about. You have a classic 1885 neighborhood rental, and yes, while they can lease for a premium, owning an asset that old comes with completely unpredictable headaches. Then you have a streamlined, modern alternative. It's in the exact same submarket, capturing the exact same tenant pool and rent growth, but it's housed in a brand new, highly efficient structure.
Which brings us right to Section 3, meet 330 North Hamilton, the new construction duplex.
Let's get to know the asset. This is a brand new construction duplex. Each side features 3 bedrooms and 2 full bathrooms, coming in at a really spacious 1,296 square feet per unit. Because this is completely new construction, it's specifically built for long-term durability. And why does this matter so much? Well, right out of the gate, it means lower maintenance and repair costs. It also means high energy efficiency, translating to lower utility bills. Whether you pay those utilities or pass them on to the tenant, lower carrying costs means stronger tenant appeal and way better retention. Oh, and it comes with builder warranties, which gives you a level of peace of mind that a 100-year-old home simply can't offer.
All right, let's get to the fun part. Section 4, the financial snapshot. Let's break down the exact numbers.
The magic number here is $450,000. That is the highly competitive purchase price for this entire turnkey duplex. For a brand new 2-unit building in an appreciating urban submarket, this price point is just a fantastic entry level for portfolio builders.
Now, $450,000 price tag is great, but what does it actually yield? Well, after all operating expenses, vacancy reserves, management fees, and your debt service are fully paid, this property is estimated to drop $702 a month straight into your pocket. Let me just repeat that. $702 of estimated, pure positive cash flow every single month.
So how exactly do we get to that number?
The two units combined generate an estimated $3,254 in total gross monthly rent. From that top line, we subtract a conservatively estimated mortgage of $1,979, assuming a standard investor loan. Then we factor in $275 for property taxes and $125 for insurance. But here's the crucial part. This model doesn't just assume sunshine and rainbows. It actually bakes in $260 for professional property management, plus a combined $263 set aside every month for maintenance and vacancy reserves. Even after accounting for all of that, a 25% down investor loan leaves plenty of meat on the bone to deliver that $702 in net monthly cash flow.
So what's it going to take to actually get in? Let's step through the math to acquire this asset under standard investor financing assumptions. On that $450,000 purchase price, a standard 25% down payment comes out to $112,500. Add in roughly $9,000 for estimated closing costs, and you're looking at a total of $121,500 in estimated cash to close. That is your all-in, out-of-pocket capital required to take ownership of this cash-flowing asset. Finally, let's jump to Section 5, Projected Investment Returns and the 5-Year Outlook.
This right here is where the magic of real estate really shines. Over the first 5 years of holding this asset, your tenants are going to pay down approximately $22,000 of your principal loan balance. On top of that, if we factor in conservative historic growth rates for this specific gentrifying neighborhood, you can expect an estimated $78,000 in property appreciation. Combine those two together, and you are looking at a staggering $100,000 in total estimated equity growth in just 5 years. It is a massive wealth accelerator.
And hey, let's not forget the cash flow we just talked about. Over that exact same 5-year period, you're projected to collect roughly $42,000 in total cash flow. When you factor that collected cash against your initial $121,500 investment, your estimated cash-on-cash return sits at a very healthy 6.3% to 7.4%. In today's interest rate environment, securing a yield like that on a brand new, low-headache asset is an absolutely fantastic foundational piece for any portfolio. We've seen the macro tailwinds pushing the Near East Side forward. We've talked about the clear operational and financial advantages of buying new construction over century-old housing stock, and we've walked step by step through the precise numbers that make 330N Hamilton a serious cash-flowing, appreciating asset. So the only question left to ask yourself is this. With new builds providing such an obvious advantage in this appreciating urban submarket, are you ready to add 330N Hamilton to your portfolio? Thank you so much for joining me for this explainer. Keep analyzing those numbers, stay focused on the data, and I will see you on the next one.